Hello, this is Joe Hoyle speaking to you today from the University of Richmond in Richmond, Virginia. We're doing the second video lesson about the conveyance of financial information. And for the first time, we're actually going to do some numbers. We're going to talk about how accounting information is conveyed and what those numbers actually mean. In this second video lesson, your uncle has started a business, and they've been in business for 3 years. And we want to see how the information about what has happened in that business is actually conveyed to outside decision makers. For example, perhaps your uncle wants to open a new store and needs to go to the bank to borrow money. Well, the bank will want financial statements. The bank will need financial information to make sure that your uncle and the store can afford to pay the loan back. So this financial information has to be put into proper form. And so here's the information that your uncle has given you. They've been in business now for 3 years. There are 3 owners to this business, and each of them contributed $20,000 apiece to start the business. That's not an unreasonable amount to start a small business operation. Each month, they have $2,000 rent expense. They have a building, they rent it, they pay rent expense for $2,000. Remember, an expense is any outflow of an asset that has a past value. So the rent expense for last month would be an expense because it has a past value. They have employees, and they're paying those employees an expense of $3,000 per month. Again, the amount they pay an employee for last month is an expense because it has a past value. They buy inventory. They're in the office supply business, and they buy inventory for $9,000 a month. And they're able to sell that for $16,000 a month. At the end of each year, they pay a total dividend, and we know a dividend is what the company pays to its owners as a share of the profits of $12,000. That's $4,000 for each of the 3 owners, and they do that each year. So we have this information, and what we want to know is how is this conveyed to outside decision makers like a banker. Now, in this particular problem, I asked for several different numbers. For example, the first number I asked for was, how do you determine gross profit? Well, we know that gross profit is the sales, and the sales here are $16,000 a month, less what that inventory cost the company. And the inventory cost the company $9,000 a month. So how much is the gross profit for this business that your uncle is running? They are making a gross profit of $7,000 per month. They buy inventory for $9,000. They turn around and sell it to their customers for $16,000. They're making a gross profit of $7,000 per month, or $84,000 per year. $7,000 times 12 months is $84,000. So if your uncle wants to know, what is my gross profit for the year? It's $7,000 a month or $84,000 for a year. What does that mean? That's the markup. That's the amount that the sales price, $16,000 a month, exceeds the cost of that inventory. Many times people want to know the gross profit percentage. The markup not in dollar terms, but as a percentage. So for example, in this problem, the markup is $7,000. You buy it for $9,000, you sell it for $16,000, you've marked it up by $7,000. If you take that figure and you divide it by the sales number of $16,000, you get the gross profit percentage. $7,000 gross profit, revenue, sales price of $16,000 is a markup percentage, a gross profit percentage of 43.75%. So your uncle and his business, on the average, is marking the goods up by 43.75%, or the sales price, the gross profit is 43.75% of the sales price. Again, another important way that information about the business is being conveyed. A third number that your uncle will need to know is the net income. How much bigger does the company get this year because of its operations and other activities? How much by selling supplies does that company grow? Well, I know that they grow gross profit $7,000 per month. But they have to pay $2,000 in rent and they have to pay $3,000 in salary. So they are actually able to grow. They actually make a net income each year of $2,000. That's the $7,000 minus the $2,000 minus the $3,000. Net income per month is $2,000. Now, of course, there's 12 months in a year, so their net income from the year is $2,000 per month for 12 months or $24,000. So if your uncle asks, how much profit am I making? How much is my net income? It's a $7,000 gross profit minus $2,000 rent minus $3,000 salary. Net income is $2,000 per month or $24,000 per year. Every company reports this way. This gives the information that people want to know about a company. How much do the owners put in? That's an easy question. Your company also gets bigger, not just from net income, but also from the owners putting money into the business, contributed capital. Each of these owners put in $20,000 each. There's 3 owners. The business grew by $60,000 because of the contributed capital, because of the owner's investment. And finally, one of the most misunderstood terms in all of accounting is retained earnings. Retained earnings means how much bigger did this business get since it first began as a result of its operations and the other operating activities. Now, they've been in business for 3 years. In that 3-year period of time, how much larger has this business gotten? Because they sell office supplies. Well, we've already determined that the business has a net income, a growth of $24,000 per year. However, they pay a dividend of $12,000 a year. They share with the owners $12,000 of this. So how much bigger do they get every year from operations? They make a net income of $24,000. They pay a dividend of $12,000. They grow annually $12,000. Each year, $12,000 bigger. Net income minus dividends. They've been in business for 3 years. So how much is the growth from being what they want to be, from being an office supply store? $12,000 per year, 3 years, $36,000. That number is referred to in financial accounting as the retained earnings. So if you pick up a set of financial statements for Bank of America and you find the term retained earnings, probably be a very large number, that tells you all the net income since that company first began, minus all of the dividends they have ever paid. That is how much larger Bank of America got since the first day it began as a result of being a bank. Now that's the kind of information, that's the kind of numerical data that helps outside decision makers start to get a picture of the financial health and future prospects of an organization so that they can decide, should I buy the stock? Should I not buy the stock? Should I give them a loan? Should I not give them a loan? Should I go to work for them? Should I work for someone else? This is the kind of information that helps us to become wise decision makers. I'm Joe Hoyle. I'm speaking to you from the University of Richmond. I hope you have a great day. I hope you're enjoying learning financial accounting.